Imagine you are the CEO of a massive global powerhouse.
Okay, I'm picturing it.
Right. So you've got access to the smartest minds in the industry. You have the most advanced data analytics money can buy. And yet, you literally cannot answer the absolute simplest question in finance.
Which is?
How much money do we actually have right now?
It's wild, honestly.
It is. So today we are doing a deep dive to uncover this massive hidden secret in the corporate world. Welcome, everyone.
Yeah, thanks for having me. I mean, it sounds completely absurd when you say it out loud like that.
Right.
You would naturally assume a Fortune 500 company can just, pull up a master dashboard, hit refresh, and see their global net worth down to the exact cent.
Yeah, exactly.
But the reality is far more complicated and, honestly, a lot more fragile than you'd think.
Okay, let's unpack this, because the article and the companion blog post we're using as sources today, they detail this thing called the unified ledger imperative.
Right, the unified ledger.
And they frame this whole issue not as dry accounting, but almost like a high-stakes detective story.
Which it really is.
There's this overarching concept they bring up called the consolidation paradox.
Yes, the consolidation paradox. That is key.
Like, at the individual entity level, say you have a single subsidiary operating over in France. You have these highly sophisticated ERPs processing millions of transactions in real time, completely flawlessly.
They work beautifully at that local level.
Right. But the paradox kicks in at the group level when you try to aggregate all those individual subsidiaries together into a single global picture. The process just devolves into something incredibly primitive.
It really does. And that paradox is exactly why this matters to you, the listener.
Totally.
I mean, you might not be a CFO,
Yeah.
but you are a consumer.
Yeah.
You're an investor, maybe you hold a pension, or you're an employee of one of these massive corporate groups.
We're all tied up in this.
Exactly.
Yeah.
We all rely on the financial stability of these organizations. But the stark truth the sources highlight is that a group P&L is rarely a true financial statement.
Wait, really?
Yeah. It is more often than not merely a controlled estimate.
A controlled estimate. That phrase is just wild to me.
It's a very careful choice of words.
Because, we tend to think of corporate financial reports as absolute mathematical facts.
Like physics or something.
Yeah, exactly. Like an unchanging law of the universe. But let's bring this into the boardroom for a second.
Let's do it.
Because there's this incredibly uncomfortable moment that happens during every financial close process.
Ooh, the board meeting moment. Yes.
So the finance team has finally assembled the consolidated P&L. The board pack is beautifully formatted.
It looks perfect on the surface.
And a board member looks right across the table at the CFO and asks, "Are we confident in this?"
It is the ultimate test for a CFO.
And they start sweating.
Well, yeah,
Yeah.
because the honest answer is a very nuanced, very uncomfortable yes within the limitations of our process.
Oof.
Right. I mean, the CFO knows the closed calendar was followed. They know the manual adjustments were made.
Sure.
But that absolute ironclad confidence that every single top-line number traces perfectly back to a verifiable source transaction.
Yeah.
That is incredibly rare. The sources actually have this great quote. They say the group P&L is either the most powerful management tool in the organization or the most elaborately constructed fiction.
Wait, so you're telling me Fortune 500 companies are essentially duct taping their global profits together and just guessing?
I wouldn't say guessing, but
It makes me think of a swan,
a swan.
Yeah, like you look at the final board presentation, and it's this beautiful swan gliding smoothly on the top of the water.
Oh, I see where you're going with this.
But underneath the water, completely out of sight, it's just the finance team paddling furiously, right? Just desperately trying to keep the whole thing afloat.
That is a perfect analogy.
Yeah.
And what's fascinating here is that the people doing that frantic paddling,
Yeah.
they're not at fault.
Right, they're not just being lazy.
Exactly. These aren't careless accountants making simple errors.
No.
These are brilliant, highly trained finance professionals who are just completely trapped in a bad architecture.
Trapped by the system.
Yeah. They are forced to construct that controlled estimate because they fundamentally lack a unified view of the group's financial performance.
Because of the tech they're using.
Right. They are working with legacy infrastructure that was never, ever designed to give them certainty at the consolidated group level.
But I mean, if they have top-tier accountants, the math shouldn't be this hard.
Right.
You'd think so. They just need to add the numbers up. If it's an architecture problem, like what is the actual anatomy of this mess?
Well, it breaks down into a few specific structural failures.
Why does consolidation devolve into a total nightmare.
Because fundamentally, it's not a math problem. It's a translation problem.
A translation problem. How so?
Well, most large corporate groups didn't just appear fully formed overnight.
Right, they grow over time.
They grew organically, or they acquired other companies over decades. So you end up with massive data heterogeneity.
Which means a whole bunch of different systems.
Exactly. You have a landscape where different entities are running entirely different software systems.
Right.
One subsidiary uses SAP, another was built on Oracle, and a third is on some custom mid-market platform they've been running since 2005.
And they literally speak different software languages. Like a U.S. parent company acquires a German subsidiary, and suddenly you have different charts of counts, different ways to label cost centers.
Completely different vendor identifiers.
Yeah. An account code in the U.S. means something entirely different when you're in Frankfurt.
Exactly.
Yeah.
And even if you miraculously standardized all the software overnight, which never happens, you run face first into a multi-gap nightmare.
Multi-gap.
Yeah. Generally accepted accounting principles, global groups operate under multiple accounting standards simultaneously.
Oh, wow.
So the UK entity is reporting under UK FRS, the US entity is using US GAAP, the Brazilian entity uses BR GAAP.
And none of them match up perfectly.
No, but the parent group needs to present the final consolidated numbers in a single standard, usually IFRS.
Okay, so you have to translate all those local standards into a single global standard.
Right. And getting from local rules to international rules isn't just like mapping a column on a spreadsheet.
It's more complicated than that.
Way more. You have to make substantive, complex adjustments. Like if US GAAP treats a real estate lease one way,
Right.
but IFRS treats it as a completely different type of liability, you can't just pull the raw data.
You have to do the math all over again.
You have to actively recalculate and adjust it for every single entity, every single reporting period.
Wow. Here's where it gets really interesting, though, because it's like trying to host a massive family potluck, you know?
Oh, I like this.
Yeah, imagine everyone brings ingredients measured in different units.
Right.
So the flour is in cups, the sugar is in grams. Some people are cooking in different time zones.
Good luck with the oven schedules.
Exactly. And some people are paying for their ingredients in yen while others use pesos.
Hmm.
And you, as the host of this potluck, have to somehow combine all of this chaotic input into one perfectly baked cake.
That potluck analogy is spot on, actually, especially the yen and pesos part.
Yeah, currency stuff?
Yeah, because multi-currency translation is arguably where the most friction happens.
Why is that?
Well, you can't just take the exchange rate on the last day of the month and apply it blanket style across the board.
Oh, you can't. I just assumed that's what they did.
Nope. You have to apply closing rates for balance sheet items, but average rates for income statement items, and then historical rates for equity components.
Wait, what? That sounds like a nightmare.
It is, and when you run the same native currency balances through 3 different exchange rate methodologies, the debits and credits no longer match.
So they literally mathematically break.
They break, you inevitably get discrepancies.
Wow.
And in a manual, fragmented process, those discrepancies often just get dumped into a plug account.
A plug at it?
Yeah, they just explain it away as rounding differences.
Which is absolutely terrifying when you're talking about global conglomerates moving billions of dollars.
It really is.
Oh, hey, our balance sheet is off by $12 million. Let's just round it out in a suspense account.
Happens more than you'd think.
That's crazy. And it gets worse, doesn't it?
Oh, yeah.
When you stack up the software mismatches, the multi-gap adjustments, and the currency chaos,
Yeah.
you still have to deal with intercompany eliminations.
The dreaded intercompany eliminations.
Which honestly, when reading the sources, seems like the most frustrating part of this entire puzzle.
It is a massive pain point.
Yeah.
Because, in theory, it should be simple.
Right.
If entity A sells a product to entity B, and they are both owned by the same parent company,
Yeah.
that transaction has to cancel out to 0 on the group's books. It's an internal transfer, not external revenue.
Right. It's just taking money out of your left pocket and putting it in your right pocket. You didn't actually make any new money as a whole company.
Precisely.
Yeah.
But in practice, they almost never cancel to 0 perfectly.
Why not?
Imagine the UK subsidiary ships inventory on December 31st.
Okay.
But the U.S. subsidiary doesn't receive it and log it until January 2nd.
Oh, I see the problem.
Right. The U.K. has recognized the revenue in one fiscal year, but the U.S. recognizes the cost in the next.
Ouch.
And add to that the fact that some entities might have completely misaligned fiscal calendars.
Like what?
Like a Japanese entity ending its year in March, Well, the parent company ends its year in December.
Oh,
And
man.
mismatches just multiply exponentially.
So just to get this straight, the UK books a sale in pounds in December. The US books an expense in dollars in January.
Mm-hmm.
They're using two different ERPs with completely different chart of account codes.
Yep.
And the corporate finance team has to somehow identify those two exact line items and force them to eliminate against each other.
Yes, that is exactly what they have to do.
That sounds impossible.
And when they inevitably don't match exactly, you generate what's called an intercompany residual mismatch.
Another discrepancy.
Right. The key takeaway from the sources here is that these mismatches getting forced to zero and the currency differences getting labeled as rounding.
Yeah.
These are not human errors. They are the structural outputs of an architecture that was never designed for certainty.
It's built into the system.
Exactly. You cannot mandate your way out of it.
Okay, so when you look at that reality, there is no software natively reconciling all of that out of the box.
Nope.
Which means somewhere, right now, there is an army of finance professionals trying to duct tape this together.
A very stressed out army.
Yeah. They are coping with this by turning to the ultimate flexible tool in every corporate arsenal. Massive, fragile Excel spreadsheet.
Classic spreadsheet trap.
They are building manual mapping tables, running endless VLOOKUPs across thousands of tabs, and just praying the macro doesn't crash.
And that becomes their single biggest vulnerability.
Really, just the spreadsheets.
Yeah. Spreadsheets are entirely flexible, which means they are entirely manual.
Ah, I see.
A global consolidation done in Excel is completely dependent on the specific people who built it.
Right.
And it is only correct if it is executed without a single human error.
Which never happens.
Exactly. There's almost always that one guy. Let's call him Steve.
Good old Steve.
Steve built the master macro 5 years ago.
Oh, no.
Right. If Steve leaves the company, or if a junior analyst accidentally hard codes a cell instead of using a formula.
Or someone forgets to update a mapping rule when a new entity is acquired.
Exactly. The whole house of cards can come down.
That is terrifying.
And because the data is aggregated across so many opaque tabs, it is incredibly difficult to detect the error until it's too late.
Because it lacks a true audit trail.
Precisely.
Now, I have to push back here for a second.
Let's go for it.
If I'm a CFO listening to this and my architecture is a mess, my first instinct isn't to buy an entirely new data architecture.
What's your instinct then?
I just want my team to use Excel better. Implement stricter controls. Because if you marched into any global finance department and told them you are eliminating spreadsheets, there would be a literal riot.
Oh, absolutely.
You cannot take away their Excel. They'd string you up.
And you shouldn't. That is a crucial distinction the sources make.
Oh, really?
The goal is absolutely not to eliminate Excel.
Okay, good.
Excel is a brilliant, vital presentation tool. Board members, analysts, and audit committees, they expect to see data presented in specific, customized, pivotable ways.
And only Excel can really deliver that.
Right. The problem isn't Excel as a canvas. The problem is using Excel as a database.
Ah, I see. Using it to store and calculate millions of rows of disparate transaction data.
Exactly. It is a terrible data management tool.
That makes sense.
That is where the broken formulas and manual errors happen.
So what's the alternative?
The objective is to feed Excel validated, centralized, lockdown data.
Instead of them doing it manually?
Right. Rather than having accountants manually copying and pasting numbers from 5 different ERPs into a workbook just to do the math themselves.
Take the data management out of Excel, but keep it for presentation.
You've got it.
That makes total sense. So if massive manual spreadsheets aren't the answer for the heavy lifting, but the final destination still needs to be an Excel board pack, what goes in the middle? How do you actually redesign the data landscape to fix this?
This brings us to the core solution from our deep dive, the unified ledger.
Okay, unified ledger.
It's an architectural fix designed to sit right in that middle space. But it has very specific requirements to actually work.
Like what?
First and foremost, it must be completely source agnostic.
Meaning it doesn't care what software you use.
Exactly. It has to sit above all those different ERPs, the SAPs, the Oracles, the legacy systems,
Right.
without forcing the individual subsidiaries to change how they operate locally.
Because
Exactly. It's just not practical. So the unified ledger extracts the data exactly as it is via API or a direct connection.
Okay.
But then it applies a group chart of accounts.
A group chart of accounts.
Yes, this is the translation layer. It's a governed semantic foundation where all those quirky local conventions and account codes automatically map to a single unified group standard.
So it's doing the translation automatically. When the U.S. code says 1001 and the German code says XYZ, the semantic layer knows they both just mean office supplies at the group level.
Yes, exactly.
It standardizes the data structurally before anyone even looks at it.
Precisely. And it doesn't stop at translation. It tackles the multi-gap problem, too.
Oh, how does it do that?
Instead of panicked, ad hoc journal entries being made manually at 11 p.m. on the last day of the month,
Right.
the unified ledger uses a maintained version-controlled library of auditable adjustment templates.
Meaning the system already knows that to get from US GAAP to IFRS for this specific entity, these specific lease adjustments need to run.
Exactly. It's systematized.
So it's not heavily reliant on a single accountant remembering to post the entry.
Yes. And because the data is standardized, normalized, and centralized in one place, it naturally solves the multi-output imperative.
Multi-output imperative.
Yeah, so you don't need one team preparing the management board reports, a different team preparing the digital statutory filings like IXBRL, and a third team making the Excel summary sheets.
Because if those three teams are using different data, you risk filing conflicting numbers.
Exactly. But from one single unified data set, you generate all of those outputs simultaneously.
Oh, that's smart.
They always match because they share the exact same DNA.
So what does this all mean for the people actually doing the work?
It changes everything.
Because the holy grail of this new architecture seems to be something called full drill-through visibility.
Yes, drill-through visibility is the game changer.
When I was unpacking the mechanics of this from the article, it immediately made me think of a financial Google Maps.
Oh, I love that comparison.
Think about it. When you open Google Maps, you can zoom all the way out and look at the entire globe, right?
Right.
That's your consolidated group P&L. You see the massive top-line numbers. But then you can seamlessly double-click on a specific country, then double-click down to a specific city, then a street.
Yep.
And finally, you are looking at the street view of a single house.
That is exactly how the unified ledger functions.
Really?
Yeah. You can click on a consolidated billion-dollar revenue line and trace it down through the entity contribution.
Wow.
Down through the gap adjustment that modified it, through the currency translation rate applied that specific day.
All the way down to a single $50 source transaction sitting in the local German ERP.
Yes, and you do it in seconds without losing resolution.
That is incredible.
It is, because the unified ledger preserves the metadata of the transaction at every single stage of transformation.
If we connect this to the bigger picture, think about how that completely transforms an external audit.
Oh, it's night and day.
Historically, an external auditor points to a massive consolidated number and says, prove this.
And then the finance team scrambles.
Right. They dig through emails, they trace VLO up apps across disconnected spreadsheet tabs.
They hunt down manual work papers just to assert a connection to the original source.
It takes weeks of exhausting effort.
And with a unified ledger, the auditor can just click the number themselves.
Oh, wow.
They trace it straight back to the origin independently.
That's huge.
It shifts the entire function of a finance team. They stop managing complexity.
Which usually just means throwing more human beings and late nights at a messy, manual close process.
Exactly. They stop doing that and they start managing control. They move from data gathering to data analysis.
It's the difference between hoping the numbers are right and fundamentally knowing they are right.
Exactly.
You aren't presenting a controlled estimate anymore. You are presenting an absolute mathematical truth.
And that shift is monumental for corporate governance.
So let's bring this all together for you, the listener.
Yeah, let's wrap it up.
Whether you are prepping for a high-stakes meeting with a CFO, whether you're an investor trying to read the tea leaves of a complex annual report,
Right.
or you just love understanding the hidden plumbing of the global economy, you now know the big secret.
You know why the group close is such a monumental challenge?
And you know the exact structural failures that make it so hard.
But more importantly, you are now equipped with the critical questions that every board of directors should be asking right now.
Ooh, what should they be asking?
Well, to test if their P&L is just a duct-taped controlled estimate or a highly reliable financial statement, they need to ask their CFO a few things.
Okay.
How many different ERPs actually contribute to this top-line number?
Good one.
How are our gap adjustments maintained and versioned? What is our intercompany residual mismatch, really?
That's the left pocket, right pocket issue.
Exactly. And crucially, if an auditor needs to verify a consolidated number, how fast can we trace it all the way back to the source transaction?
Those are incredibly sharp questions.
They'll definitely start a conversation.
If a CFO starts sweating and looking at their shoes when you ask them how fast they can drill through to source, you'll know exactly why.
Oh, yeah.
They're probably thinking about the terrifying monster Excel spreadsheet currently holding their entire department hostage.
This raises an important question, though, and it's something for you to mull over as we wrap up today's deep dive.
Lay it on us.
We've established that this unified ledger architecture isn't science fiction.
Right, the capability exists right now.
Exactly. It is actively removing the old excuse of technological limitations.
Because the tech is there.
So if the absolute truth is truly just a click away,
Yeah.
will regulatory bodies like the SEC soon decide that relying on manual controlled estimates is actually a form of gross negligence?
No, wow.
When executives sign off on consolidated financial statements, ignorance of the messy manual plumbing underneath is no longer going to be a valid legal defense.
Because they could have fixed it?
Exactly. If the tools exist to know with absolute certainty, failing to use them might soon be seen as a direct liability.
Wow. That is a chilling thought for anyone still relying on a fragile web of spreadsheets.
It really is.
That beautiful swan might be swimming in legally perilous waters very soon.
Well said.
Thank you so much for joining us on this deep dive. Keep questioning the numbers behind the curtain, and we'll catch you next time.